We are stifling innovation. The innovation is happening somewhere else.
Side deposits were less movable years ago than they are today.
Today it can happen through mobile applications, and the deposits can be taken away at the touch of a finger. Most of the systemic risk, the systemically relevant financial institutions, is missing this digital potential. In the US, most of the banking market is a shadow banking, is not commercial banks. In Europe is a bit the opposite. 80% is still banks and 20% is only the shadow banking.
I'm not seeing why alternative lenders should be any different from the traditional lenders.
Your high-frequency trading and your more speculative investments aren't properly rewarded for investing in the real economy.
Losing a couple of banks a year is not a problem. If you can click a button and move your problems away, why would you wait?
Hello and welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik. My co-host is Sir Michael Fallon. Our guest today is Francesco Filia, founder and CEO of Fasanara Capital. Hello, Francesco. Good to have you on the show.
Thank you for inviting me.
Francesco, recently the concept of narrow banking has become very popular, and you seem to be an eager supporter of this concept. Why is that?
I think that what happened to Silicon Valley Bank and Credit Suisse is not by chance, and it has been mistakenly attributed to certain factors, but instead it was linked to others. So, for example, in the case of Silicon Valley Bank, the prevailing narrative indicated that the bank failed due to mismanagement of the hedging on the treasury book that resulted into noise, including the Peter Thiel Twitter that created havoc and created like an outflow from depositors primarily skewed to venture capitalists. So venture capitalists had their money deposited with the bank, and venture capitalists overreacted to tweets and noises following mismanagement of the hedging book. I believe that the real reason for the failure of the bank is a different one. It has got to do with the funding base of the bank, which is the same as many other banks, of course, most other banks, which is daily depositors. So depositors that they can disappear overnight. And the proof of it is that a few weeks later, you would have an unrelated event happening across the ocean to Credit Suisse. And in this case, there were not $42 billion disappearing in a day. There were 400 billion plus disappearing in a matter of a very few weeks that led to the demise of Credit Suisse. And,
yeah, but that's sorry, Francesco, but this is like an old story, right? Because the banks have a mismatch between durations of their liabilities and assets, and
correct.
This is how banks operate.
Correct. What is new today is the following: is that, and of course, the banks also have another issue, which is not only they have a lot of liabilities with a longer duration, but they also have leverage, right? So for the same unit of capital, they have 10 units of loans out there. And by the way, this 1 to 10 average used to be 1 to 40 during Lehman Brothers, and led to the demise of Lehman. So what is different today? Because you're right, that has always been the case, and ever since we have had the fractional banking reserve system, we have had these types of leverage, and ever since the global depression, we have had these daily depositors that can result into bank runs. So what is different today? Today, what is different is the pace of exit. So the speed at which deposit outflow can occur. In the past, like especially during the Great Depression, but also years ago, you had to queue up at the subsidiary of the bank asking your money back. And that's why we have this imaginary from the Great Depression of people queuing up, right? Today is different. It can happen overnight because it can happen through mobile applications, and the deposits can be taken away at the touch of a finger, right? And so it can happen a lot faster. So what we defined is like flash cash runs or flash bank runs. As we move forward, we're going to see more of it as we move on blockchain eventually. And we're going to see that this may happen even overnight and during the weekends. So the direction of travel is set for this risk to be a lot bigger in the future. But let's discuss about today. Today it can happen on mobile applications. It can happen very, very fast. And so that is the problem. That is why the funding structure of a bank today is a lot more fragile than 10, 20, 30 years ago.
So basically, what you're saying is that side deposits were less movable years ago than they are today, right?
Exactly. And so
Because
the vulnerability of banks-
because you don't need to wait in the queue. You just need the time to reach your pocket and take your phone out.
Correct. And then also include the fact that the users are young generations, more and more as we go by, and these young generations are more and more short fuse, and that the first few noise indicators will decide to move away fast, if they have an option to do so, which they do. Like the narrative, the global prevailing narrative today, is that moms and pops will not move their cash away because it takes too much work. And they are used to a certain set of banks. And this is the narrative, especially in Europe, where they say what happened to Silicon Valley Bank, what happened to Credit Suisse is not going to happen again on European banks. But I dissent. I think that perhaps we don't do that, but our kids will consider doing it much quicker. And therefore, the risk of a flash bank run is a lot higher than is currently estimated also by the systemic risk institutes around the globe and by their estimation of liquidity coverage ratios for commercial banks and the likes. So today, most of the systemic risk looks at the systemically relevant financial institutions, is missing this digital bank runs potential, which I think is going to strike again soon on other banks. And so this leads me to believe that the funding structure of a bank is not the ideal one to lend money to the real economy in many cases, especially on long-dated leverage stuff. And I think that this is why I think narrow banking is rising. Narrow banking, in my own simple definition, means banking without a leverage, effectively, right? Happening at 1 unit of capital, 1 unit of loans out there. And if you think about the trend in the industry today, it's kind of confirming that this may be the case. Banks are moving more into a originate to distribute model. You've seen the recent transactions done by Mubadala together with I believe it was Apollo and BNP Paribas and Citibank, where effectively banks operate as originators, and then the capital comes from asset management industry, Apollo in this case, with the help of some other investors like sovereign wealth fund like Mubadala. So, and you've seen similar stuff several months ago, there was a book of consumer loans from Barclays going the way of a large KKR, I believe it was. And then you see also recent transactions by Elliott on the Klarna book. Prior to this, there was KKR on the PayPal book. So you see that more and more of these funding structures get done by asset managers instead of by commercial banks. I think this goes in the same direction. Of course, you could argue these funds sometimes utilize a lot of leverage, right? And therefore, at that point, they don't get included into my definition of narrow banking or what could be sustainable in the future. But still, you have that, as a main indicator out of all of that, you have that perhaps the banking balance sheet is not the ideal one to lend money sustainably to the real economy for purposes such as these ones.
This is fascinating, Francesco. So what is the answer here? Is it to let that kind of trend develop? We've had, 10, 14 years of new regulation after the last crisis. Is it a regulatory failure in the end? The regulation hasn't caught up with the digitization of these transfers? Or is it that the compliance is not adequate?
It's a very good question, Michael. I don't know if I know the answer to this. I think it's a combination of things. I don't think it's a regulatory failure. I think that definitely what the regulators, the policymakers could do is to be a little bit more aware of it. I don't think that the LCR, the liquidity coverage ratio, cuts it.
So it's the supervision, is it?
This is from a supervision point of view. I think more could be done to estimate the risk so indicators that are more fit for purpose for a digital economy. And the way the economy will look in 10 years from now, because let's not forget that today, this is the risk, SVB and Credit Suisse happening to other banks.
But what is the risk here, Francesco? These were adults, Silicon Bank. These were adults, they got rebanked somewhere else. What is the damage here? Who has lost?
Well, for example, I can tell you, the damage is big because if it happens again and it happens to larger financial institutions, it's going to be a very big deal, right? I'll give you one simple example. What if after Credit Suisse deposit outflow that led to its demise, we had the same happening to UBS, for example, for the sake of argument. So during the Credit Suisse outflows, the safe haven was considered to be the largest bank in Switzerland, which was UBS. But what if the panic attack and the panic from investors would have hit UBS itself? At that point, it would have been a very big issue, difficult to manage, even for the SNB, the Central Bank of Switzerland, because those two banks together, they're just too big for the Central Bank of the country. The country is too small. And we know how much leverage there is in those banks compared with the real economy in Switzerland. So that could have been a problem of like monumental proportions. And so like we need to take into account that those panic moments could spread around, right? And we need to account for that. We need to stress test for that.
But this is the old argument of too big to fail, and making sure that your stress tests are right and that your consumers, particularly in the very big banks, your voters, are protected by your state institutions.
Yeah, what I say is that like narrow banking would be a much more solid way of doing things, where leverage ratios are a lot lower than they are today, and they would be more respectful of the vulnerability of a funding structure which relies heavily on daily deposits that can disappear overnight in more and more frequency going forward. So that is the mismatch, asset liability mismatch, which I think is inherent in the banking system today. And I think that something could be done to analyze it further and better.
Yeah, but with this concept of narrow banking, you also have a source of funding. For example, you have an investment fund which provides loans, which means that it practically works as a shadow bank. Unlike the real-life bank, this fund will have permanent or quasi-permanent capital, because it may impose some withdrawal constraints on their investors. But nevertheless, it's still some liabilities which this bank is not going to be able to leverage. So my problem with this, I have two problems with this. The first one is that, again, the management of assets versus liability duration is going to be very important. And the second thing is that currently banks operate with a significant bank multiplier. What is it, around 10? So 100 pounds or dollars you invest in a bank, you have in your account in the bank becomes 1,000 in loans. With a fund, you won't be able to leverage that much. What is going to mean for the economy?
Yeah, so and this leads into also conversations about the money multiplier, the velocity of money. I believe there is a lot to say about that, also related to productivity. There is a lot to say about that with the digital economy. A lot more. The new economy of the future will look a lot faster in general, even without that leverage in the banking system. So, but let me answer your questions. Like your question is, why do we think that funds are also necessarily more stable? It depends on so many other factors, and this is absolutely true. Like not every fund is created equal. Fund can mean many different things, and at this moment they are not as regulated as banks, and therefore there is even more variety out there. So the way I define a fund which is sustainable and could do this job is a fund that uses a lot less leverage than the banking sector. But not only that, also a fund that is funded by the right investors in the right way. For example, a fund which doesn't utilize leverage, which is funded primarily from institutional investors for more than 90%, which means insurance companies and pension funds, for example. And a fund which distributes across its stakes to funders in a very diversified manner, where no single investor is more than 10% of the total AUM, assets under management. That is a fund which is more resilient against the shocks that may lead to withdrawals, which happen also at the fund level. So if every one of the funder of the investment fund are permanent type capital, like insurance company pension funds, if each one of them is no more than 10% of the total, and if the fund itself does not utilize leverage, that is conducive, probabilistically speaking, to a more resilient funding structure, which is more amenable to lending to the real economy in a sustainable way over the decades. Like I give you an example. This funding structure could lead to effectively you having the certainty of funding for a lot longer than you can have when you purely rely on daily deposits that can disappear overnight. Not only that, at this moment the capital does not come from depositors, which are retails and individuals, comes from pension funds and the insurance companies, which are a lot more forward-looking, long-term, permanent type capital. Not only this, but when you look at the job description of these pension fund insurance companies, perhaps what they should do is more real economy stuff. Less speculative plays on bonds and stocks, and more real use by real companies and real individuals in the real economy.
Excuse me, Francesco, but when you buy stocks or bonds, you finance a company or the government.
This is true at the theoretical level, but as you know, Igor, the asset management industry is a lot more than just a pricing tool and an allocator to the real economy to worthy projects. Today, there are things such as huge leverage, high-frequency trading, speculators, long-short equities, all of those derivations or derivatives of the main target. You cannot really call them allocation to worthy projects in the real economy. They've taken a life of their own.
Well, Francesco, I think that you might be reaching a bit too far. Who is going to decide which projects are worthy and which are not?
Well, banks, for example, today, they don't do speculation on public markets. They do allocations to the real economy. And what I'm saying is that they do a good job. They just have a funding structure which may be fragile against the future digital economy. So banks are doing worthy projects, for example, more than hedge funds that they are speculating in and out high frequency on public assets, for example. So that is like the judgment level, if you wish. So all of what I'm saying is that these pension fund insurance companies, they have an opportunity to do the job of the banks if they are proposed with the right technology and the right way to directly take the real economy and borrowers. And they should do more of that instead of allocating speculatively across the public markets. But I agree with you, it's not always the case. I don't want to look like I'm simplifying things too much. I understand that there are a lot of good funds out there. There's a lot of worthy projects that they support, etc., etc. But I mean, in general, I see that these pension funds, insurance companies, now that they have through technology and financial technology in particular, the one that we also spend so much time on as a firm at Fasanara, now that they have a possibility to directly lend to the real economy through fintech platforms, for example, they should consider it a lot more, because it's a sustainable way of supporting the real economy, which is purposeful as well. And when you think about pension fund insurance companies, by the way, you think about the largest balance sheet out there. We're talking about more than 100 trillion globally. So it is the elephant in the room, and it's never had the real possibility to directly connect to the real economy until now. Then this technology allows for it, and therefore has had to allocate its capital differently, and sometimes in a good and plain vanilla ways, like balanced portfolios, but sometimes also in speculative ways. And I have a bit of an issue with these speculative ways.
Yeah, but is it the weakness of banking supervision? The fact that we lose a couple of banks a year, important banks, we have all the risks associated with that. Is that the issue, or is it that your high-frequency trading and your more speculative investments aren't properly rewarded for investing in the real economy?
That's a good question. So, I think losing a couple of banks a year is not a problem, right? Unless it spreads
could be healthy.
around.
It could be healthy, Francesco.
It could be healthy. No, absolutely. It's in a system, you always lose some pieces, and the system benefits from it when the weakest links are selected out. But what I'm talking about is the fragility of the financial system at the aggregate level that may lead to outsized overreactions and damage to the financial system itself. Like what I'm talking about is a fragility in the financial system which has gone undetected because the prevailing narrative belittles it to some other factors. Like Silicon Valley Bank made a mistake in hedging their treasury book, or like Credit Suisse did some risky loans in the past. They did the Archegos mistake, they did the Green Seal mistake, etc., etc. I think that misses the point to some extent, and we should be aware that there is a lot bigger, systemic risk within the funding structure of commercial banks today than we seem to acknowledge for.
I would agree with this. But I'm just not sure that reducing the leverage in the system is a solution, because it will lead to troubles of its own.
So, I think reducing the leverage of the banking system is happening. right? So it's happening ever since the global financial crisis during Lehman 2008. We know Lehman defaulted at the time in which the leverage was 40 times. And today we are talking about something around an average of 10. I think there are already discussions like by regulators to further decrease it. So in a way, like there is this direction of travel, right? We are going in that direction. What I mean is that it's good that we do that. I see value in it, and it should even accelerate this direction of travel. Because I think that as it is, we are not taking into account some fragilities in the system, which if they deflagrate in the wrong way, disorderly, they will not help anybody. And so I think that also our vision for the real economy and the digital, our vision for the financial systems to help the real economy is also going through technology, of course, right? So what we look at, and we have advantage position here in Fasanara because we move money in this market, is all this emergence of fintech platforms. These fintech platforms are effectively non-bank financial institutions, so they are shadow banking. But even before we talk about that, let's talk about asset managers that they do credit work, for example. In the US, most of the banking market is a shadow banking, is not commercial banks. In the US already, 80% of the loans is originated by shadow banking, not by regulated banks. In Europe, it's a bit the opposite. 80% is still banks and 20% is only the shadow banking. By the way, by shadow banking, I mean fintech platforms, I mean asset-based securities, warehouse facilities, funds, asset managers, and the whole lot, right? So in the US, what I'm describing is kind of happening already. And what I was mentioning before, like the recent transactions by Apollo with Mubadala and Citibank and BNP, or by KKR with several other factors, they seem to indicate the same, right? That the banks, they go for the originate to distribute model. The risk is taken by balance sheets, which are in the asset management industry. And so it's kind of happening already, what I'm describing.
You think that Europe is going to catch up?
I think Europe is going to catch up to the US. And I think that the US is keeping on going in that direction. I think that if we meet again in 10 years, the total amount of loans from commercial banks in the United States won't be 20. It will probably be 10% only. I think there is no coming back from that. There is no reversion to the mean. I think it's a direction of travel which is unilaterally going in a certain direction. And I think that it's happening for a reason. It's the system that is rebalancing itself to be more stable.
And do you see any downside to banking supervision heading this way?
Well, no, I think banking supervision should go this way with more acknowledgement of the fragility of the system that is inherent in this daily deposit risk, right? So the risk of a flash bank runs, I think, is under-examined at the level of the supervisor. And I think that more should be done in order to create indicators that they quantify that properly and they stress test for
Sure,
it.
but in doing that, do you see any downside? I mean, are we likely to squeeze out some of the innovation that's actually been helpful to the system?
I don't think the innovation is happening at the banking level anyway, since a long time ago. So no, I don't think there is a downside in terms of a stifling innovation. If anything, innovation is coming. The new look. I mean, I started working in banking in 1997, and the best job you could get then was to go to a merchant bank, an investment bank, because that was the frontier where innovation happened. And I think that was true until 2008, when there was the Lehman demise and the global financial crisis. From that point onward, the frontier of innovation moved into the buy side asset managers. And from there also a fintech and fintech platforms, and from there also blockchain and cryptocurrencies, et cetera, et cetera. So, of course, AI today is the word of the day, of the last few years. So that is the frontier of the innovation. So I don't think that by overburdening further regulation on commercial banks, we are stifling innovation. The innovation is happening somewhere else.
And where is that somewhere?
Somewhere else, for example, today in financial technology, including also the blockchain. I think that is where you see all the emergence of these startups all across, that they are innovating in multiple directions, including also, of course, artificial intelligence and LLMs. But I think that the idea, so for example, when it comes to lending to the real economy, there is more and more fintech lending platforms globally doing that. in parallel to the banks, and very often also supported by the banks with the financing structures, and supported also by funds like Fasanara, of course. So these are fintech platforms that they are like benefiting from the trend that I'm describing, and they're growing year after year for a couple of very simple reasons. The user experience is a lot better for the borrowers, for the users of this capital, both individuals and SMEs or small and medium enterprises. And two, they can do that in a sustainable way because they don't utilize leverage. And therefore, when the credit cycle has its gyrations, they're more likely to survive it. When I look at it from the viewpoint of the policymaker, I actually would like to see that they do their job because they are anti-cyclical. So one of the big problems with the commercial banks is that they are pro-cyclical. So very often during a credit cycle, they tend to exacerbate it by stepping out of the market right at the wrong time. This we have seen during the global financial crisis, for example, that banks would step out right at the time in which the market needs funding to get out of the crisis itself. That is the definition of a credit crunch and the overcompensation to the downside that happens during it. So if you have a circuit breaker in alternative lenders operating at the same time, but not operating with the same pro-cyclicality, I think it's good at the system level.
But why do you think those alternative lenders are going to operate with a different cyclicality?
With a different set of what, sorry?
With a different cyclicality. Why do you think they're not going to follow the same cycle? Any lender will want to lend when the probability of repaying the money is high, which happens during good times. It doesn't happen over bad times. So
yes, you're right.
I'm not seeing why alternative lenders in this regard should be any different from the traditional lenders.
You're absolutely right. But for once, they don't utilize leverage, or not a lot of it, in my definition of it, which is narrow banking, right? So I'm not talking about the shadow banking system in general. I'm talking about, I guess, if you want to define it, shadow banking system, narrow banking style. So no leverage. Very often, one of the reasons for you to get out of the market during an increase of the probability of default, for example, as you described, is because you have leverage. You are pushed out of your own positions because you are receiving margin calls. That they are asked to reduce your leverage because you're going through a tough time. But if you don't have a leverage in the first place, you're not going to have that impetus, right? And you may look just at tightening your credit standards, moving into sectors less affected by the crisis as it unfolds, et cetera, et cetera. So there is a less violent overreaction to a credit crunch than there is when you are a leverage player like a bank is.
Yeah, that's right. Thinking about it in terms of a typical stock portfolio, right? You can be leveraged that you are more vulnerable, but if you can go only from 0 to 1, you don't need to get to 1. You may invest 20% of your money into stocks, not 100% of your money. So eventually you can deliver even if your maximum allowed leverage is non-existent, if it's only 1. You can go under 1, and this is what people will do.
Absolutely. No, you can still operate in a way that is following the cycle, but not with full pro-cyclicality. I give you an example. So the full pro-cyclicality during the global financial crisis was widespread, right? So it was rating driven, for example. As you know, during a credit crunch, ratings, they get cut, right? And that has got a perverse incentive, a collateral effect, a domino effect, because then the banks will be able to do even less. And not only the banks, right? Not only the banks. I don't want to put it just this on banks. It's just one of the major actors in the financial system. But so this rating is also related to trade insurance providers. So the likes of Allianz Trade, the likes of Atradius, Coface, et cetera, et cetera. It's very often the case that during a credit crunch, trade insurance is withdrawn. Trade insurance lapses, right? So you lose your coverage, you lose your rating, and you need to cut exposure fast because you have leverage. So it's a combination of factors. It's not one single element. But this combination of factors has a big correlation and overcompensation to the downside during the unfolding of a credit cycle, which the regulators, the supervisors, and the policymakers are looking at with attention and with a bit of concern, of course, because they are scared about the systemic risk. And the very definition of the systemic risk and the vulnerability in a system is when a small shock can create an outsized effect, right? So that is the definition of fragility. So if you can put some speed bumps, some circuit breakers for actors that they behave a little bit differently, you diversify your risk across, right? You make sure that the severity of that credit crunch, whenever it happens, is lesser, right? Today, all of the burden has been taken by central banks themselves to step in as the lender of last resort, or fiscal agents to overly spend on the fiscal side of things, right? Fiscal dominance, I guess, is the right word for these current times. But I think that the system is also rebalancing itself at the ground level, privately, where effectively more actors are born and in a greater dimensions year after year that are less cyclical, more resilient, more designed for the long term, less leveraged, and I think the economy can benefit from it.
But the central banks are not just, they don't have only one weapon of stepping in. They are able to set tougher stress tests, for example. They're able to adapt those stress tests to some of the changes in the marketplace. What is stopping them doing that?
No, I think they are doing it. I mean, I think that they are doing good moves, right? In the unfolding of the global financial crisis, they stepped in with a lot of TARP, LTROs, and then you have a quantitative easing, and then you had all sorts of things, right? So they created a safety net, which created 10, 15 years of growth after that. Where the S&P was back then, I think it's 666, and where it is today. Right? So
awesome, yeah.
They're doing the right things. In the meantime, they monitor risk and the unfolding of risk in the digital economy. What I'm saying is that they should do a lot more to take account of the fragility of the banking sector coming from the funding structure of it, right? So, but I'm not trying to criticize a priori, what they're doing. I'm just trying to say, hey, perhaps you should be more attentive at what's happening to Silicon Valley Bank and Credit Suisse and read it in the right way instead of attributing it to wrong factors, which I think doesn't help.
Okay, you mentioned a better user experience. Why the user experience should be better when I borrow money from a fintech platform rather than from a traditional bank?
Well, so fintech platforms are very often, by definition, decentralized agents, which are very localized in their respective markets, and they take care of very narrow verticals, meaning there is a certain user experience that they target and they try to do well, data-driven. So empowered by data, right? So it's a user experience which is a continuous feedback loops that tells you if it's working or not. Number one. Number two, it is very localized in a single country on a single user experience. For example, one of our platforms is Scalapay in Italy. They do only buy now, pay later. So they only take care of one user experience, which is the clients going online at the checkout point and providing them payment options or funding options, financing options. So they only focus on that. If you compare that with a bank offering the same service, the bank at the same time will look at everything else, all the other cohorts of clients, all the other financing options for clients, all the other services to sell to the same clients. They're omni-channel. They do everything. So I think that by focusing on a specific user experience in a specific country, on their based modeled customer behavior, they can do a better UX. And this is what I think is happening, and that's why, in aggregate, they are growing a lot year after year.
Yeah, okay, but if I'm a client, I'm a borrower, I have a very simple problem. I need to borrow a certain amount of money for a certain amount of time. So I'm coming to a bank, I know the process, I'm coming to this fintech platform, which is so beautifully constructed, it's decentralized, and it uses all the modern techniques and so on. But what does it mean for me?
It means that, for example, you may be able to get your loan much faster in a better user experience, meaning that the bank would normally ask you to fill a form for you to get a consumer loan. And they would give an answer to you after weeks, if not months. And perhaps the answer is most of the time no, unless you really qualify on every tick the box. Whereas in this case, you have a counterparty that provides you with leverage much faster in an online experience of KYC, AML, accreditation, that allows you to have a mobile app that checks all your balances, and so you know how much you're levered at each point in time. So that takes care properly, that is client-centric on your needs.
Speaking about AML checks and compliance checks, how exactly can this be done? When you go through a KYC procedure with banks or with any financial institution nowadays, they will conduct very, very thorough tests on you, asking you all kinds of questions which you wouldn't even have thought about. How is it going to work here?
Well, now here it's working in similar ways, but where effectively is a simplified process. There is not admittedly the same level of regulation that is burdening banks today. So it's not a level playing field that goes in the favor of these fintech platforms. Is an element, but by the way, it was lamented by Jimmy Dimon at JP Morgan during his shareholders letter of 2020, if I'm not mistaken, in which he was lamenting that there was no level playing fields between the fintech lenders and banks, and it was unfair from his standpoint. And surely it is to some extent. But this helps to simplify the AML KYC process as well. Of course, it needs to be going through the standards of the regulator in the respective jurisdictions. Otherwise, it's illegal, right? So it needs to still be done properly, but it is to be admitted that it is lighter. But there is a way to make it lighter. So one of the reasons why banks don't manage to do it is because they have a very difficult time at doing the IT upgrade. Banks are notoriously incapable of properly revamping their IT infrastructure because they have too many legacy infrastructure ecosystems not speaking to each other already. They have too much vested interest as well. So whenever they need to go through a technology revamp, it takes ages, and typically the money is not well spent, and it doesn't lead to much. There are very, very few examples of banks globally that have managed to play the technology game properly, like JP Morgan, Goldman Sachs, Santander, Standard Chartered. There are a bunch, but it's very, very tough to find many in the list. There is also another reason, if I can say, Igor, banks are very profitable. So they are sitting on their laurels. Their belly is full. It's not that they need to innovate, right? So, and the incentives are all, sometimes it's all there is. Right? If you don't have the right incentive to innovate, you will not innovate, or you will not innovate to an extent that allows you to be the main players 20 years from now, as you are today.
It's interesting that you are saying about legacy code. Okay, banks developed their platforms years and possibly even decades ago. And of course, there is a lot of legacy software sitting there. But 10 years from now, the platforms which are so brand new today are going to be running legacy code, which will be 10 years old. We're going to bump into exactly the same problem.
It will take a while before we get there. But if you count the number of banks today, you have the answer, right? There are thousands and thousands of players already. The market is hugely fragmented already. So this is not discovering anything new, that there will be many actors as well in the future. Some will fail because they are unable to consolidate at a level that still makes possible to make an efficient job. Some new ones will be born, and it will keep being a race, right? But my conviction is that if you establish your business today, it's like kind of the second mover advantage. Right? If you started today with no legacy infrastructure, you're able to do a mobile-only, cloud-based, data-driven, business driven by artificial intelligence, for example, instead of by the number of people working for you. You have a much better chance at success than if you are a legacy infrastructure with subsidiary everywhere, lots of headcount, and no ability to automate or to innovate.
Let's assume that we will be moving into this brave new world of distributed fintech platforms which will be able to provide loans without any leverage. Can you think of unknown unknowns? So, for example, banks only get 10% or 5% of the credit market instead of today's 20% in the US or 80% in Europe. So the banking system shrinks, a lot of jobs lost, the leverage in the system goes down. Any other implications?
Well, look, a job lost in one sector, but added on another one. So this is just the market economy and the financial system evolving, right? I think there is the potential to have a lot more jobs produced, but of a different type. It won't be people doing the current jobs when the value add of the current jobs is low. It will be people looking at more value added segments of the real economy. And this is also goes in line with the fact that the commercial banks are cutting employment. right? So they themselves realize that they can do the same job with less workforce, and that's why it's happening globally across the space, right? So this is not in itself like a negativity that I see from the market. And here we're not talking about how much AI will replace workforce. Hey, right, I'm not discussing that. I'm just simply discussing fintechs versus banks. So I don't think that it's a net detractor of jobs necessarily. Just look at the sheer number of fintechs that are born every year, and that they go in multiple directions, providing services that are provided better than banks, but also new services that the banks were not providing. So this in my opinion, is potentially opening new segments of the market. And I think, of course, like the system will have vulnerabilities. Nevertheless, it's not enough to decrease leverage to get out of trouble. And the system should go into troubles every now and then. Like it's a way for the system to shake the tree and deselect weaker parts and focus. It's like when you do portfolio pruning, right? Or you're pruning a tree, right? You're cutting some dead wood in order to create the possibility for the sap to flow in the right direction. So the system will always go through levels of volatility, and this is positive, right? It's got a positive effect. But you need to be careful about systemic risk, and the system spinning out of control completely and creating the types of crises that we've seen during the global financial crisis, the dot-com crisis, the global, the Great Depression, and the likes.
It's just that we don't know all the implications of this transition. And there are certain things we can't even think about right now. And you mentioned systemic risk. Yes, there is systemic risk associated with banks, clearly. But I'm not sure that as we move to this new system, the systemic risk is going to dissipate. It will become slightly different. One form of risk morphs into another form of risk, but it will still be there in the system.
Definitely. As I said, that the system will go into levels of volatility as time goes by. There is no way to make the system perfect, right? And it wouldn't be a system otherwise, I guess. It would be, and there is no way to centrally plan this either. Most of what I'm describing is bottom up. It's just that the system that it itself rebalancing in ways that make it more sustainable. And so it's I believe in the systems theory, and into stable states for systems, right? And very often when you reach a critical threshold, you're going to runaway velocity, and you transition. You do a critical transition. I think this is what we are going through today. That you go from a less stable system into a more stable one, but it's definitely a different stable state, a different position for it. And but yes, none of what I'm saying leads to us getting away from risk in general, right? Not at all.
But you want it all to move faster. That's what I take away from this. You think slowly the supervisors and the regulators understand this. They do want to move towards your own, your own position, but you want them to do that faster.
I think so. I think that the next banking crisis we get, if it is still misattributed, it doesn't help anybody, right? If it is misattributed to a risky loan that they did, or to a tweet that was published, or to some wrongdoing at the banking level, won't be as useful as if attributed to the right thing, which is perhaps the funding structure is really vulnerable, and we need to do something about it. And we need to create some more ring fencing, some more safeguards that they prevent this little trouble in the next bank to spill over into other banks and become virulent.
But there were people here in Europe, certainly, who have been pointing to weaknesses in the Swiss banks for a long time.
But again, it could be a non-Swiss bank, right? My contention is that it happened to Credit Suisse, it could have happened to other banks as well. If the vulnerability for Credit Suisse was well identified in terms of, but you see, the definition of a fragile system, or under Edward Lorenz and chaos theory, and I'm talking to two very intellectual people, so you will know this better than me, is that you can have the flapping of the wings of a butterfly in Japan, creating an earthquake in Texas, right? So you don't need much to create a runaway and an outsize. So the fragility of a system is the inability to deal with external shocks, right? This is my contention. So it happened to Credit Suisse due to some external shocks, which are easily identifiable. But it could happen next to a bank for which it was not so obvious, and still you have the same type of virulent reaction from the market. Today, it's still not happening because of this resiliency of the mums and pops. I think this is going to change. The kids of the mums and pops are going to move a lot faster, are going to be a lot more short fuse, overreacting to things. They're not going to take any chances. If you can click a button and move your problems away, why would you wait, right? Why would you wait just because you have a relationship? You don't have a relationship. It's a very no-relationship business, the business of the future. It's much more data-driven.
And it's easier to switch.
It's much easier to switch, and we should all be doing that. So like today is like washing through, right? You go from one bank to another, and you think you have solved your problem. But I think it can happen in ways in which it creates a domino effect. And this is something that can create unwanted consequences.
Indeed. All right, Francesco. It's been a very interesting conversation. We're just running out of time. I would like to thank you very much for joining us.
Thank you, Igor. Thank you, Mark. Thanks a lot. A pleasure to be in.
Thank you. Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.